Welcome to the Deep Dive, the place where we take the vast complexity of global industry, grab the most vital sources, and really distill them down to the essential, fascinating knowledge you need.
Glad to be here.
Today, we are immersing ourselves in what feels like, well, a dizzying dual reality within the global energy services sector.
That's absolutely right. We're looking at two very different yet, deeply intertwined narratives.
Okay.
On one side, you've got this phenomenal hard operational data coming out from a major offshore contractor, Subsea7. It shows really robust growth, a clear market recovery, actually.
Right, like boots on the ground success.
Exactly. It's a story of ground level project success, things getting done.
But then on the other side, we're analyzing this incredibly high-stakes, multi-layered drama. It's
Yeah.
all around the proposed mega merger that's set to create Saipem 7.
A transaction aiming to build, what, a 43 billion financial fortress? Huge numbers.
Huge. So our mission today is to try and connect these two realities, to understand what it actually takes to execute these massive deepwater projects.
And then see how that operational success runs, well, head first into some really serious multi-jurisdictional geopolitical friction. It's quite the contrast.
The initial hook, I think, is just how stark that contrast is. You've got Subsea7 reporting adjusted EBITDA growth of 23% year on year.
Yeah, driven by operational excellence, pure and simple. It suggests a contractor market that's firmly finding its footing again. Pricing power seems to be returning.
Which they've needed for a while.
Definitely.
Yeah.
Yet all that stability, all that positive momentum, it's almost overshadowed by the intense political scrutiny this merger is facing.
Right. Brazil's antitrust body, Cade, is basically threatening to dismantle the deal, maybe mandating the divestiture of critical vessels.
And at the same time, you've got the Italian government wielding its golden power,
The Golden Power, yeah.
imposing national security mandates, and specifically linking essential assets to technologies like, get this, underwater drones.
Underwater. Okay, that adds a whole other layer.
It really does. It's the ultimate tightrope walk, isn't it?
Yeah.
The market demands scale, efficiency, consolidation.
But sovereign states are stepping in, asserting strategic control, and potentially just overriding the commercial logic.
Precisely. So let's maybe unpack the operational engine first. See how Subsea7 managed to thrive even while its future corporate structure was facing this regulatory, well, maelstrom.
Okay, let's dive into those core numbers for Q2 2025, because the results here, they really paint a picture not just of growth, but of decisive strategy actually paying off. What was the headline financial performance?
Well, the adjusted EBITDA came in really strong at $360 million,
Okay.
which, as you noted, that's a 23% jump year on year. But the number that really stands out, for me anyway, is the margin expansion,
Right.
370 basis points.
Mm.
That pushed the quarterly margin up to 20.5%. Now, that isn't just about being busy. That signals real pricing power and execution discipline are back in the contractor's court, especially after years of, intense client price pressure.
Yeah, that 370 basis points, that margin expansion, it's definitely not trivial. It suggests they're not just winning jobs, they're winning profitable jobs.
Exactly. And that success, it immediately translates into future visibility. The order intake was, well, massive. $2.5 billion in Q2 alone.
Wow. $2.5 billion.
Yeah, and that intake resulted in a quarterly book-to-bill ratio of 1.4x.
Okay, so bringing in more work than they're completing in the quarter.
Correct. And if you look at the entire first half of 2025, the book-to-bill was 1.0x. So basically, for every dollar of work they executed, they secured a new dollar of work. It's just relentless momentum.
And that momentum, it feeds directly into, well, a kind of financial fortress, right? Resulting in a really strong total backlog of $11.8 billion.
Yes, and that backlog provides extraordinary near-term certainty, something for you, the listener, to really consider.
How certain are we talking?
Well, look at it this way. They have $3.6 billion already slated for execution in the remainder of 2025. That gives them over 90% revenue visibility for the full year.
Over 90%. That's incredible visibility.
It is. And crucially, they already have $3.7 billion secured for execution in 2026.
Okay.
So this confidence allowed management to just reaffirm their full-year guidance. Revenue projected between $6.8 billion and $7.2 billion.
Right.
And maintaining that adjusted EBITDA margin target of 18% to 20%, which, implies EBITDA growth exceeding 20% year on year. Solid numbers.
And it sounds like they're growing without really compromising their financial stability. Let's talk about the cash generation and the balance sheet for a second.
Yeah, good point. Net cash generated from operating activities was $339 million. And that included a healthy $59 million improvement in working capital,
Meaning they're getting paid efficiently.
pretty much. And critically, capital expenditure, the CapEx, was manageable at $93 million. This wasn't reckless spending. It was very targeted investment.
Like what?
Specifically, it included the final payment for that monopile installation equipment for their key renewables asset, the Seaway Ventus.
Ah, investing in the future.
It's exactly investing in high-spec assets that align with future growth trends like offshore wind, while still maintaining a strong liquidity position of $1.2 billion. Net debt was around $695 million, but that includes about $448 million in lease liabilities. So fundamentally strong.
Okay, so they're self-funding their growth, upgrading assets strategically. Now let's zoom in a bit on the two key business units, because you said this is the core of the margin story. How did the traditional subsea and conventional unit fare?
Right, so that core unit, it saw revenue broadly flat at $1.4 billion. But, and this is the key part, its adjusted EBITDA grew to $301 million.
Okay.
That single jump pushed the margin up to 21.2%. That's a staggering 400 basis points in a year.
400 basis points. That's a huge strategic win, not just a random fluctuation.
Yeah.
Where did management pinpoint the source of this profit surge?
It was multifaceted, really. High activity levels were reported across key geographies: Brazil, the U.S., Turkey, Norway,
Yeah.
the usual suspects. But the crucial factor they cited was a favorable shift in project mix. Since around 2022, they've been highly selective, deliberately bidding on contracts that offer a better risk-reward balance.
So discipline paying off.
Absolutely. This margin boost is the direct payoff of, well, walking away from low-margin, high-risk work and choosing projects where their integrated expertise actually commands a premium.
And this margin recovery wasn't just limited to traditional oil and gas, right? Their renewables unit, Seaway 7, that mirrored the success.
It did, yes. Revenue there was up 9% to $307 million, but the EBITDA saw an impressive 40% leap to $53 million.
40%.
Yeah, which resulted in a 17.4% margin, up 380 basis points itself. Key projects driving this included those huge UK offshore wind farms, Dogger Bank C and East Anglia 3A3.
Okay.
So the big takeaway here is that both major segments are demonstrating this ability to execute large, complex scopes of work and, crucially, do it profitably.
Right. And when we talk about execution, we really need to look at the immense physical engineering challenges that are underpinning these financials. Norway, particularly, seems to be where they deploy their most complex technology.
Okay, definitely. What's fascinating about Norway is just the sheer ambition of the projects they're involved in, often leveraging their partnership with Subsea through the Subsea Integration Alliance.
Okay.
Take the Ormen Lange Phase 3 project, for instance. This wasn't just about laying pipe. They delivered the integrated EPCI for the flow lines and installed multi-phase compression systems.
Subsea compression.
Yeah.
That sounds incredibly difficult.
It is. You're talking about complex pumps and controls located hundreds of meters beneath the sea surface. Very challenging engineering.
And the strategic impact of getting that right.
Oh, it's massive. This phase, which actually started up in June, is projected to unlock an additional 30 to 50 billion cubic meters BCM of gas.
30 to 50 billion.
Yeah, and that gas is specifically earmarked for export to Europe. So that elevates the project from just a commercial success to, well, a geopolitical stabilizer in the European energy landscape.
Wow. Okay, moving to the flagship development, Yggdrasil. That project sounds staggering in scope, targeting 450 million barrels of recoverable oil. What does Subsea7's role involve physically there?
Well, their scope involves installing pipelines, naturally, but also two very large, complex pipeline bundles.
Pipeline bundles. Can you explain what those are for the listener?
Sure. A pipeline bundle is essentially a prefabricated structure. Think of it like a big pipe containing other pipes and cables. It holds the main production pipeline, insulation, maybe smaller flow lines, control umbilicals, all enclosed within a larger carrier pipe.
Okay, all packaged together.
Exactly. These things can be kilometers long. They fabricate them on land at their facility in Wick, Scotland, and then they tow the whole thing out and submerge it precisely on the seabed.
That sounds incredibly precise.
It is. It's highly specialized engineering. They use their key assets, like the 7 Vega and 7 Oceans pipe-lay vessels, for that kind of work.
And beyond just maximizing traditional resources, Norway is also where they're proving their capabilities in the energy transition space, particularly with carbon capture and storage, CCS.
Right. The Northern Lights CCS project is really the blueprint for future large-scale carbon infrastructure. They completed phase 1, that was the 100-kilometer CO2 pipeline EPCI.
Okay.
And now they're deep into the engineering for Phase 2 with installation planned for 2026. And Phase 2 isn't just a small extension, it's a major step up.
How major?
Well, it aims to increase the CO2 storage capacity from 1.5 million tons per year to at least 5 million tons per year.
Wow, more than tripling it.
Exactly. This demonstrates their ability to scale up this kind of critical transition infrastructure, potentially exponentially.
That sustained activity is clearly critical. And they're also winning these brownfield projects, right? Extending the life of existing fields, which must provide that long-term, stable revenue stream.
Oh, absolutely. Brownfield work is the bread and butter that keeps the fleet utilized between the huge new projects. New awards like Estfrig, part of Yggdrasil actually, use their proprietary pipeline bundle design from WIC, with offshore work stretching out to 2027.
Okay.
From SUR is another good example. That's an EPCI tieback to the existing Troll C platform. It's an economically attractive way to maximize the investment that's already there.
Makes sense.
And they're also engaged in crucial FEED work that's front-end engineering design for ConocoPhillips' PPF project, which is about rejuvenating the massive Ekofisk field.
Ekofisk. That's one of the real giants, isn't it? An older North Sea field.
It is. And revitalizing an aging giant like that requires incredibly specialized engineering. They'll likely need to use one of their heavy hitters, probably the 7 Borealis, for that work.
Okay, so shifting focus now. Let's go from the cold north down to the intense competitive waters off Brazil. The story changes a bit there, doesn't it? The sources indicate activity is high, but the competition is fierce, mainly due to the nature of the client, Petrobras.
Yeah, Brazil remains the absolute engine room for deepwater development globally. It's all focused on those massive pre-salt fields. Tendering activity is definitely high.
New prospects coming online?
Yep, new prospects like Miro Wave 2 and Buzios Wave 2 are being added. And these projects are strategically aimed at maximizing production from existing FPSOs, floating production, storage, and offloading units
No.
by utilizing empty riser slots. It's basically about finding incremental, profitable production from infrastructure that's already in place. Smart economics.
But given that Petrobras is essentially the sole massive client there, they must wield enormous contracting power. How does that affect the market dynamic for companies like Subsea7?
It creates, as the source states, very, very tight competition. Petrobras is highly active, very sophisticated in its procurement strategy.
They're not just looking for the lowest price.
Not necessarily. They're also interested in ensuring there's sufficient competition, maintaining a robust multi-vendor landscape. They're actively inquiring, for example, about the availability of a large rigid pipelay vessel, a PLSV, to work alongside the flexible lay vessels already operating there.
Ah, so they want options.
They want options and they want to keep the pressure on. It keeps contractors like Subsea7 highly efficient and ensures asset availability is absolutely paramount. Subsea7 expects to win its fair share, but they acknowledge they have to be razor sharp on costs and delivery. No room for error.
Okay, finally, let's fling back to offshore wind. The future trajectory for their renewables unit, Seaway 7, seems highly dependent on a single government process over in the UK.
Yeah, the momentum there really hinges directly on the outcome of the UK's allocation round 7, or AR7.
That feels right.
The auction process is due to commence in August. But the results, partly because of potential legal appeals and processes, aren't actually expected until early 2026.
Early 2026.
Wow.
That's quite a wait.
No, it is, and it's a critical timing element for getting these big wind farm projects sanctioned and moving forward.
And AR7 is particularly significant because the government seems to have learned from past failures, right? They dramatically increased the strike price to try and make the projects financially viable again.
Precisely. The maximum strike price announced for AR7 is 113 pins per megawatt hour.
Which sounds high.
It is, especially when you compare it to previous rounds. AR6 basically failed at 73 pins per megawatt hour, and AR5 was way down at only 44 costs.
Wow.
Those past rounds struggled or even failed because the economics just didn't stack up against rising inflation and material costs. So this increase to 113 pins is the government signaling, okay, we hear you, these projects need to be sanctioned.
It's a big signal.
It's huge. For the entire European offshore wind supply chain to stabilize and regain confidence, a successful, well-priced AR7 is pretty much indispensable.
Okay, so we've established that Subsea7 is operating, well, beautifully as a standalone company right now. Excellent performance.
Yeah, ticking along very nicely.
But their ultimate destiny, at least as planned, lies in this colossal integration with Saipem, creating the entity Saipem 7. The definitive agreement was signed back in July 2025 and seems driven by this realization that future deepwater projects just demand global integrated scale.
That's the core strategic logic, yes.
Hmm.
The complexity of modern offshore EPCI engineering, procurement, construction, installation, it just requires resources that very few single companies possess anymore.
So the merger creates this diversified giant.
Exactly. A giant capable of bidding on the world's largest, most complex infrastructure packages from end to end.
Let's just try and nail down the scale here. We're talking about truly massive numbers even before any potential synergies kick in.
Oh, absolutely. Based on 2024 pro forma figures. So, looking back hypothetically, the combined entity project's annual revenue of around 21 billion,
21 billion euros.
with EBITDA probably exceeding 2 billion. But maybe the most important metric for stability is that long-term backlog,
Right, the future workload.
which stood at approximately 43 billion as of the end of Q1 2025. That kind of scale provides huge leverage, risk diversification across different projects and regions, and financial stability far exceeding what either company could really manage alone.
And the workforce reflects that scale, too.
It does. A global workforce of about 44,000 people, including, importantly, over 9,000 specialized engineers. That's a huge pool of expertise.
Now, this wasn't really a merger designed to cut staff or eliminate fleet redundancy, was it? It seems more about technical complementarity. They kind of fill each other's gaps in the whole subsea spectrum.
It's absolutely additive, not subtractive.
Receiving.
Saipem's strengths lie squarely in that heavy lift capability
Right.
and high-end rigid pipe lay solutions using very specialized assets. They are the masters of J-lay and S-lay technology for rigid pipes.
Okay, maybe for the listener, can you briefly explain the difference between J-lay and S-lay? It sounds technical.
Sure, happy to. These terms basically refer to the profile or the shape the pipe takes as it leaves the vessel and descends down to the seabed. S-lay means the pipe exits more or less horizontally over the stern of the vessel and then curves down in an S shape towards the seabed. It's generally faster and typically used in shallower waters.
Got it. S for shallow, maybe.
Sort of, yeah. J-lay, on the other hand, means the pipe exits the vessel nearly vertically, often through a tower, forming a J shape as it goes down.
Ah, much steeper.
Much steeper. This requires far more technical precision and control, but it's essential for ultra-deepwater projects where the tension on the pipe in an S-lay configuration would just be too high.
Okay.
And Saipem has the gold standard assets for this, like the massive Saipem 7000 heavy lift vessel and the cast-iron pipe lay vessel. Real top-tier kit.
And Subsea7 complements that rigid pipe lay capability with its own specialized expertise.
Exactly. Subsea7 excels in rigid reeling. That's where they essentially spool long sections of pre-welded rigid pipeline onto a massive reel onshore.
Like a giant garden hose reel.
Kind of, yeah, but for steel pipe. Then they take the reel offshore and spool the pipe off very rapidly onto the seabed. It's a different method, very efficient for certain types of projects.
Okay.
They also specialize in flexible lay services, laying flexible pipes, and the complex integration of SURF, subsea umbilicals, risers, and flow lines.
Right.
So by combining fleets, we're talking over 60 major construction vessels in total.
60.
Saipem 7 can truly offer a seamless, single-supplier EPCI solution across the entire subsea lifecycle, from the shallow water export lines right down to the deepest field tiebacks. One-stop shop.
That combination is clearly the operational justification, but the financial justification, that rests heavily on those synergy targets. 300 million annually is a massive number. How do they justify reaching that figure?
It is ambitious, no doubt, but they've anchored it in highly specific areas. The target is 300 million in annual run-rate synergies, expected by year 3 after the merger completes.
Okay, year 3.
With estimated one-off implementation, costs around 200 million to achieve it. The bulk of the savings, around 225 million of that 300 million, comes directly from fleet optimization, meaning about 200 meters in operational expense savings and 25 meters in CapEx savings. It involves making sure those 60-plus vessels are utilized much more efficiently, positioned strategically around the world, and not just sitting idle waiting for work that a complementary asset from the other legacy fleet could have actually secured. Fewer idle days, better scheduling.
So better utilization equals a lower operational burn rate. Makes sense. Where does the remaining $75 million in synergy come from?
That's expected to be derived mainly from process efficiencies, things like streamlined procurement, rationalizing the tendering processes so they're not duplicating effort, and consolidating various support functions.
Economies of scale, basically.
Pretty much, when you're buying enormous amounts of steel or contracting specialized services for what were two separate 10 billion plus revenue streams, merging them gives you tremendous bulk buying leverage. You just get better deals.
The legal structure itself sounds like a complicated piece of engineering, designed to facilitate this merger of equals.
It is quite complex. It's structured as an EU cross-border statutory merger. Technically, Subsea7 is absorbed into Saipem, which is then renamed Saipem7.
Okay.
It's targeting a 50-50% pro forma ownership split between the legacy shareholders, achieved through an exchange ratio, 6.688 new Saipem shares for each Subsea7 share.
And financially.
Crucially, the long-term financial commitment is twofold. First, to achieve and maintain an investment-grade IG credit rating. That gives them cheaper access to capital markets.
Important for a capital-intensive business.
Very. And second, a commitment to distribute at least 40% of their free cash flow annually back to shareholders after repaying lease liabilities. So rewarding investors is baked in.
And even before the merger actually closes, the shareholders are getting a pretty substantial cash thank you, aren't they?
They are indeed. The pre-completion cash reward seems designed to, well, sweeten the deal and also demonstrate underlying financial strength during the transition.
How much are we talking?
Subsea7 shareholders are set to receive an extraordinary dividend of $450 million immediately prior to the deal closing.
$450 million. Nice bonus.
Plus, another €5 million related to a separate permitted business divestment they're doing,
Sure.
and contingent on hitting their 2025 financial targets, which, as we discussed, they seem well on track for.
Right.
Both legacy companies may distribute at least $300 million each in cash dividends sometime in Q2 2026.
Wow.
It shows immense management confidence in the underlying cash flow generation, even during this complex transition phase. They're not hoarding cash nervously, they're distributing it.
Okay, so this merger is clearly commercially driven, aiming for scale and synergy. But the governance structure, when you look at it, it reveals its political DNA, doesn't it? It feels engineered to satisfy both operational necessity and national security interests.
It really is a masterclass in compromise, or at least attempted compromise. The parent company, Saipem7, will be legally incorporated and headquartered in Milan, Italy.
Okay, Italian roots maintained.
Exactly. And it will have dual listings on the stock exchanges in Milan and Oslo. That addresses Italian sovereignty concerns and the legacy of Saipem, plus Subsea7's Nordic links.
But the operational heart, the engine room, that remains elsewhere, perhaps to maintain some commercial agility.
Precisely. The core business, that's the offshore engineering construction, or ESC, unit, which generates something like 84% of the combined EBITDA.
The vast majority.
That's structured as a separate, operationally autonomous legal entity. And this E&C entity will be headquartered in London, UK.
Ah, London.
And branded as Subsea7, a Saipem7 company. This operational independence is probably vital to try and avoid day-to-day political meddling in commercial decisions. Keep the engineers focused.
And the leadership structure itself reflects this really careful balance of power, doesn't it?
Absolutely. It's quite revealing. The CEO of the main Saipem7 group is designated by the Italian state-backed entities Eni and CDP Equity, who are major Saipem shareholders.
Okay, state influence at the top.
Yeah. But the chairman of Saipem7's board will be designated by Subsea7's key legacy shareholder, Seam Industries.
So, commercial counterweight.
Exactly. The political and commercial interests are sort of locked in a permanent formal balance at the very top level of governance.
Okay, now we get to the really high-stakes friction. If the internal threat to the merger is actually realizing that ambitious $300 million synergy target,
Which is hard enough.
right, the external threat is this dual regulatory conflict, where different authorities might demand potentially contradictory actions. This sounds messy.
This is the ultimate execution risk, I think. Let's start with conflict one. Brazil and Cade Antitrust. Brazil's competition authority, the Administrative Council for Economic Defense, is scrutinizing this deal very closely,
Why?
based on the high market concentration it creates, specifically in deepwater subsea EPCI within Brazil.
And the clients there, particularly the giant Petrobras, they're not exactly thrilled about this prospect, are they?
No, they are not. Petrobras submitted data to Cade arguing that the merged Saipem 7 entity would control approximately 47% of the essential EPCI vessels required for their high-value contracts in the pre-salt region.
47%. That's almost half the available capacity sitting with just one supplier.
Exactly. And ExxonMobil apparently backed this up, voicing concerns about reduced customer options and the real risk of creating what they called a single relevant supplier in critical deepwater pipelay services.
Okay, if the main customer base is unified in its objection like that, Cade is almost guaranteed to impose some pretty stringent remedies, surely.
It seems highly likely they will impose structural remedies. That's the big stick.
Meaning,
Meaning they could actually demand the divestiture of specific high-specification pipelay vessels, PLVs, to a third party just to inject more competition back into the market.
forcing them to sell off key assets.
Potentially.
Mhm.
Or perhaps they might mandate behavioral remedies, like legally binding access agreements forcing Saipem 7 to make parts of its combined fleet available to competing operators under certain conditions. But Brazil needs to protect competition in one of the world's most strategic offshore basins. They have leverage here.
Okay, now layer onto that conflict too. Italy and the Golden Power. This is where the story really pivots from commercial regulation to, well, geopolitics.
Yeah, the Italian government has given its conditional approval but invoked the Golden Power mechanism.
Which allows.
This power allows the state to intervene and protect assets or companies deemed strategic to national defense or national security.
Oh.
And the mandates they imposed as conditions are explicit.
Such as?
Saipem 7 is obligated to maintain essential technological and patent capabilities within Italy. Okay, maybe understandable.
Right.
But most strikingly, they must also focus on, protect, and presumably develop technologies related to national defense and specifically underwater drones.
Underwater drones. There it is again. So the implication is crystal clear. The Italian state now has a functional veto power over company decisions if they're deemed contrary to national security interests.
Pretty much.
And they're explicitly linking the fate of a global commercial energy services provider to military technology development.
That's exactly what it looks like.
Yeah.
So a commercial asset, maybe a specific vessel, a piece of proprietary technology, even key engineering personnel, might simultaneously be viewed as a competitive necessity that needs addressing in Brazil and a strategic national security asset that must be protected and kept under Italian influence in Italy. This creates the ultimate legal bind.
Let's just play out that nightmare scenario, because this is where that tightrope walk you mentioned earlier becomes almost impossible.
Okay, consider this hypothetical but plausible situation. Cade in Brazil reviews the merger. Based on Petrobras' serious concerns, they determine that, say, the Castorone, which is a major Saipem rigid pipelay vessel, very capable. And Cade decides the Castorone must be divested to a competitor to reduce market concentration in Brazil.
Okay, makes sense from Cade's perspective.
But simultaneously, the Italian government, utilizing its golden power, designates the Castorone, or maybe its advanced control systems or its deployment methods, as a strategic asset. Why? Because it's critical for maintaining Italian capabilities related to national defense, energy security, or maybe even those underwater drones, whatever they entail.
So Saipem 7 management is now completely caught in a legal crossfire.
They are potentially legally blocked. They might be legally prohibited by the Italian government's security mandate from complying with Cade's divestiture demand.
What happens then?
Well, the successful completion of this entire $43 billion merger could hinge on negotiating a very delicate resolution. Maybe Cade could be persuaded to accept a less stringent behavioral remedy, like forcing Saipem 7 to share access to the vessel under certain rules, instead of demanding an outright sale.
But that's a huge negotiation.
It's massive, and it pits the economic necessity of maintaining competition in Brazil directly against the absolute sovereign authority of Italy's national defense interests. It's really an unprecedented test of global commerce versus national strategy playing out in real time.
Okay, that geopolitical tension is clearly the big external threat hanging over Saipem 7. But let's pivot now and look at a crucial internal threat to realizing those merger benefits specifically, the challenge of managing the sheer volume and complexity of data required to actually run an enterprise of this new enormous scale.
Yeah.
Because the unsung hero, or maybe the potential villain of any mega merger, isn't always the politics. Sometimes it's just about having clean, reliable data.
This is absolutely fundamental. You really can't overstate it. If you can't trust your data, you simply can't target your sales effectively, you can't optimize your fleet deployment efficiently, and you certainly can't hope to realize those $300 million in synergies they're banking on.
Right.
When these two giant companies merge, they have to ingest vast volumes of external company data, perhaps from sources like Dun & Bradstreet, into their unified CRM system, customer relationship management.
And the immediate, inevitable problem is...
Duplicates. Thousands upon thousands of duplicate records.
Why is that so common?
Because the data is often, well, poisoned by duplicates right from the source. Standard unique identifiers, things like DUNS numbers or tax IDs, they're often missing or inconsistent in these large third-party data feeds.
So you end up with multiple entries for the same company.
Exactly. If you have 5 slightly different records for Global Oil Services LLC, maybe one with LLC, one without, one with the typo, you can't accurately assign a sales territory, you can't track the client relationship history properly, it directly jeopardizes the sales pipeline and makes reporting a nightmare.
Okay, so they couldn't just rely on simple exact matching. They had to move beyond that and embrace more sophisticated, distance-based metrics to identify duplicates based on string similarity. This is the technical how part.
Yes, they needed techniques that could intelligently identify not just exact matches, but also typographical errors, alternative spellings, common abbreviations, things like that. The sources highlight 4 key approaches they likely leveraged.
Okay, let's walk through them. Start with Levenstein distance. What specific problem does that one solve best?
Right, Levenstein distance, sometimes called edit distance, basically measures the minimum number of single-character edits, so insertions, deletions, or substitutions that are needed to change one string into another.
Okay.
It's brilliant for catching simple typos or minor variations. If you compare, say, Subsea7 Co. to Subsea7 Co. with all of these instead of a 7, Levenstein will calculate a very low-distance score, maybe just one edit, flagging it as a probable match.
Got it. Good for typos. But corporate names are often abbreviated at the end, right? Like Inc. versus Incorporated. Is that where Jarrow Winkler comes in?
That's exactly the kind of problem Jarrow Winkler distance is designed for. It's actually a modification of the Jarrow distance metric, but it gives a higher similarity score if the characters match particularly well at the beginning of the string.
Why at the beginning?
Because the start of a company name tends to be the most critical distinguishing factor. Variations often happen at the end with legal suffixes or abbreviations. So, Jarrow Winkler works much better for matching something like Global Technologies, Inc. versus Global Tech, Inc. than Levenstein might alone.
Okay, handles suffix as well. What about acoustic errors? Names that sound the same but are spelled differently.
For that, you need phonetic matching algorithms like SoundX or similar approaches. These methods convert names into phonetic codes based on how they sound in English.
Ah, sound-based.
Exactly. This helps handle variations in spelling that might sound the same when spoken. Think matching Smith & Wesson versus Smith & Wesson. This is crucial when you're dealing with data sourced from multiple international regions where transliterations happen, or just common misspellings or mispronunciations occur.
Right. Okay, finally, how do they handle those really long, multi-word corporate names, the ones that often involve complex legal wording or get abbreviated drastically?
That's where a technique like cosine similarity becomes really powerful. It takes a different approach. It treats the names or descriptions as vectors of words in a kind of multidimensional space.
Vectors. Sounds complex.
It is mathematically, but the concept is about word frequency. By measuring the angle between these word vectors, effectively checking how similar the distribution and frequency of important words is between two strings, it can effectively match lengthy legal names, even if the word order is slightly different, or link a full name like International Business Machines to its common abbreviation IBM, based on shared context or keywords.
Okay, so they likely used a combination, a hybrid model, pulling the best bits from each technique depending on the type of name.
Almost certainly. A hybrid model is usually best, maybe using Jarrow Winkler plus Levenstein to catch both phonetic and typographical errors in shorter names, and then applying cosine similarity for the longer, more complex multi-word names. You tune the system.
And what was the tangible business impact mentioned? This wasn't just a technical exercise. It had a real payoff, right?
Absolutely. The ability to accurately clean, deduplicate, and normalize this vast amount of company data was the essential foundation for effective commercial targeting post-merger. This technical capability, the sources suggest, directly contributed to the successful execution of lead generation strategies, ultimately resulting in a documented $300 million sales pipeline.
Wow, $300 million pipeline value created just from getting the data clean and trustworthy.
Essentially, yes. Value created solely from being able to trust and effectively use their customer data. It's huge.
Let's briefly just detail the kind of technical infrastructure required to actually manage this process at scale. The sources mentioned a specific product example using Microsoft Azure. Sounds like a robust data pipeline architecture is needed.
Oh, definitely. You need an end-to-end pipeline. The architecture described used the Microsoft Azure ecosystem, likely chosen for its scalability and integration. It starts, sensibly, with a standardized user request interface, maybe via SharePoint, using templates to make sure data requests are consistent.
Okay, standard input.
Then the ETL process, that's extract, transform, load, is orchestrated by Azure Data Factory, ADF. ADF handles the scheduling and the overall workflow.
But ADF doesn't do the heavy lifting of deduplication itself.
Not typically for this level of complexity. The sources indicate that the heavy lifting, the actual running of those complex deduplication algorithms like Chara-Winkler and cosine similarity, the data normalization that's leveraged via Azure Databricks.
Why Databricks specifically?
Because Databricks provides a high-performance, massively scalable environment built on Apache Spark. It's necessary to run those complex calculations across potentially petabytes of data really quickly and efficiently. Couldn't easily do that just within ADF itself.
Okay, so Databricks for the heavy compute. Where does the clean data end up?
The clean, processed, deduplicated data is then loaded into a centralized data mart, likely hosted on Azure SQL database or a similar relational store, ready for analysis.
And the final step, getting it to the users.
That's the consumption layer. Power BI dashboards were mentioned, connected likely via direct query to that data mart.
Direct query meaning?
Meaning the dashboards query the database directly in near real time rather than using imported, potentially stale data. So sales teams get the latest view. And importantly, with dynamic security layers built in, restricting user views only to the data relevant to their specific assigned territories or roles.
So the right data to the right people, quickly and securely.
That's the goal. Ensures the clean data is immediately actionable by the business.
Now, this whole system, and indeed running a massive enterprise like Saipem7, relies on understanding two fundamental types of database systems. We should probably quickly distinguish between OLTP and OLEC in this context.
Yes, that's a fundamental concept in enterprise data architecture. Really important. OLTP stands for Online Transaction Processing.
Transactional, day-to-day stuff.
Exactly. OLTP systems are typically relational databases designed for managing high volumes of relatively simple, day-to-day operational transactions. For Saipem7, this would be the system managing things like vessel maintenance schedules, procurement requests coming in, employee payroll processing, real-time order entry from clients.
What are their key characteristics?
They need very high availability, data integrity is paramount, and they're optimized for very fast query processing, inserting, updating, deleting single records quickly.
Okay, and the other type, OLA.
OLAP stands for Online Analytical Processing. These are the data warehouses or data marts, designed specifically for complex analytical queries to support strategic decision-making, not routine operations.
So looking at the bigger picture.
Precisely. OLA is what Saipem7 management would use to interpret that huge 43 billion backlog, to forecast resource needs across their combined 60-vessel fleet for the next year, to model the progress of realizing those 300 million synergies.
What makes OLP systems different?
They focus on handling complex, multidimensional queries, slicing and dicing data across different dimensions like time, geography, project type. They're optimized for trend analysis, forecasting, strategic planning, understand the why behind all those transactions recorded in the OLTP systems. You need both working together.
Right, you need the transactional engine and the analytical brain. Finally, let's just quickly revisit that innovative use of generative AI mentioned in the sources. It wasn't just traditional data processing.
No, it seems they're also leveraging generative AI, specifically mentioning using Azure OpenAI services, or maybe models, from Hugging Face via APIs.
For what kinds of tasks?
For tasks that traditional rules-based systems really struggle with. The example given was the automated translation and, more interestingly, the classification of potentially thousands of different job titles coming from the two merged workforces.
Classifying them how?
Classifying them consistently by department and seniority level, even if the original titles were inconsistent or in different languages. This seemingly small technical capability can dramatically improve internal resource planning, but also external sales targeting and lead generation, knowing who the right decision maker is within a client organization.
So again, even advanced AI here is being applied directly to achieve better commercial outcomes from that massive, newly cleaned and integrated data asset.
Exactly. It all ties back to making the data usable and valuable. Tag outro.
Okay, we have taken a really deep dive today across multiple layers of, well, reality in the energy services world. We started with that immediate, tangible operational success story of Subsea7.
Yeah, that 23% EBITDA growth, the strategic margin expansion, that robust forward-looking project pipeline, especially in key areas like Norway and Brazil.
Yeah.
Very solid performance.
And then we connected that operational success to the enormous structural challenge and opportunity of the Saipem 7 mega merger. We detailed the strategic necessity for that kind of scale.
The ambitious but crucial 300 million 50 target is great.
And the absolutely critical importance of mastering that technical data quality challenge, the internal foundation needed to underpin this entire massive operation.
But the shadow that's still hanging over that planned 2026 completion date remains that complex, multi-jurisdictional friction. It really pits the economic necessity of competition, championed by Brazil's Cade and critical clients like Petrobras.
Against the absolute strategic authority of a sovereign state mandate Italy's golden power, tied to national security and defense interests.
Which creates a really fascinating and maybe quite challenging existential question for you, the listener, to mull over. The merger is clearly designed to create this global powerhouse, a player capable of executing the world's largest, most complex energy projects, from deepwater oil and gas right through to carbon capture and offshore wind. Essential infrastructure.
Yeah, the kind of scale needed for the energy transition, arguably.
But if a single sovereign government, using mechanisms like the golden power, can effectively legally veto purely commercial decisions related to international competition, like forcing the divestment of a key vessel.
Exactly. And potentially vetoing it over assets linked, bizarrely, to their strategic control of underwater drones. What does that actually mean for the future of integrated global energy delivery?
It's a profound question. Does sovereign strategic control ultimately override the commercial and competitive necessity of consolidation in this incredibly capital-intensive sector? Yeah. Could it even risk fracturing the global supply chain needed for these huge projects?
It's a fascinating tension, isn't it, between the corporate boardroom logic and the national cabinet room strategy. We'll have to leave you to chew on that one. Thank you for diving deep with us today.
Always a pleasure. Until next time.